Buen día, compañeros y profesor Eric de Tecnología de Análisis de Costos y Presupuestos, Ingeniería Financiera. Yo soy Joseph Antonio Malambo y el día de hoy vengo a leerles este artículo del portal Science Direct que trata sobre Big Data, información financiera, información contable y valoración por el autor Doron Nissim. This paper reviews research that uses big data and/or machine learning methods to provide insights relevant for equity valuation. Given the huge volume of research in this area, this review focuses on studies that either use or inform on accounting variables. The article includes by providing recommendations for future research and practice. Keywords: big data, machine learning, valuation, financial misstatements, earnings forecasts, stock return predictability, XBRL survey. Introduction. The term big data is not well defined. It is commonly used to describe a range of different concepts, from the collection and aggregation of vast amounts of data to a plethora of advanced analytical techniques designed to reveal relevance patterns. For example, the European Commission defines big data as large amounts of different types of data produced from various types of sources, such as people, machines, or sensors. This data could be climate information, satellite imagery, digital pictures and videos, transition records, or GPA signals. Big data may involve personal data, that is, any information relating to an individual, and can be anything from a name, a photo, an email address, bank details, posts on social networking websites, medical information, or a computer IP address. Oracle defines big data as larger, more complex data sets, especially from new data sources. These data sets are so voluminous that traditional data processing software just can't manage them. Data that contains greater variety, arriving in increasing volumes and with more velocity. The three B's. Variety refers to the many types of data that are available. Traditional data types were structured and fit neatly in a relational database. With the rise of big data, data comes in new unstructured data types. Unstructured and semi-structured data types, such as text, audio, and video, require additional preprocessing to derive meaning and support metadata. With big data, you'll have to process high volumes of low density unstructured data. This can be data of unknown volume, such such as Twitter data feeds, click streams on a web page or a mobile app, or sensor-enabled equipment. For some organizations, these might be tens of terabytes of data. For others, it may be hundreds of petabytes. Velocity is the fast rate at which data is received and perhaps acted on. In addition, references to big data often imply or are implied by the use of artificial intelligence methods, especially machine learning algorithms. While there is not an unequivocal definition of big data, the use of data and analytics consistent with at least some aspects of the term. High volume unstructured data machine learning has prolife- proliferated in finance and accounting research and practice over the last 2 decades. These papers reviews research that uses big data and or machine learning ML methods to provide insight related to the use of accounting information in equity valuation. It focuses on studies providing insights about the quality and forecasting of earnings as well as on the use of accounting information in evaluation risk and predicting stocks returns. Earnings quality is included in the review because it is relevant for the valuation in determining or adjusting price multiples or in forecasting the profit margin used to derive a free cash flow in DCF. See Nissim. After reviewing insights from extant studies, the paper provides recommendations for future research and practice. The ability to conduct granular accounting-based analysis across large sets of companies has increased in recent years due to improvements in data availability and modeling techniques. In particular, the Securities and Exchange Commission's (SEC) mandated structured disclosures in extensible business reporting language (XBRL) format now provide comprehensive machine-readable as field financial statement data for essentially all U.S. public companies. These data enable more accurate and consistent measurement of accounting factors, which may yield more informative insights. In addition, developments in ML methods enable the extraction of insights from large sets of financial variables as well as from unstructured data, which can be used to predict financial misstatements, earnings, and stock returns. They also allow more efficient estimation of relevant parameters and latent variables. As reviewed in this paper, most of the accounting big data related research to date focus on using big data, primarily textual and oral ML methods to extract information from or about accounting variables while paying relatively little attention to variable measurement and accounting relationships. Several recent studies employ XBRL data now to facilitate more accurate measurement of accounting predictors of earnings or stock returns, and a few incorporate structured financial analysis. These paper calls for a greater emphasis on the selection, measurement, and contextualization of accounting variables in implementing ML algorithms. It also highlights the importance of conducting big data ML research on the measurement and valuation of intangible assets. The paper proceeds as follows. Section 2 describes studies that use big data or ML methods to predict financial misstatements or to inform on the quality of accounting estimates. Section 3 discusses a study that provide evidence on the informativeness of big data or LM methods about future revenue or earnings. Section 4 describes research that uses big data or ML methods to inform on risk dimensions. Section 5 reviews studies that provide evidence on the usefulness of textual firm disclosures and all ML methods applied to accounting features in predicting stock returns. The Section 6 provides recommendations concerning the use of big data and ML methods in accounting research and practice. Here in this article, we are just going to go directly to the section 6, that this discussion and summary. Well, the above review provides many examples of studies that employ big data or ML algorithms to inform or extract insight from accounting variables. There are several important areas that have received relatively little attention to date. I elaborate on two such topics, which in my view are especially important. One, the use of big data and or ML methods to measure the amortized cost and value of intangible assets. And two, the incorporation of economic, financial, and accounting structure in implementing ML algorithms. Relatively few studies use big data or ML methods to provide evidence on the amortized cost or value of intangible assets. This is an extremely important area, and big data ML methods have the potential to generate substantial insight on these assets. The amortized cost of intangible assets is difficult to measure because, one, investments in intangible assets are often mingled with periodic costs, employees that develop and maintain software, for example. Two, some investments in intangible benefits the current period in addition to future periods, advertising. And three, the pattern of the benefits is highly uncertain, so any amortization scheme is likely to produce poor matching. The value of intangible assets is difficult to measure because the cash flows associated with investments in intangible intangibles are less certain than those from fixed assets. This is due to several factors, including one, greater uncertainty compared to investments in fixed assets regarding whether the investment will be successful. Two, if the investment is successful, the benefits may be much higher than those from successful investments in fixed assets due to scalability, network effects, optionality. An invention in one content can lead to other applications. And low variable costs. And three, unlike most fixed assets, intangible assets have little or not exit value if the project is unsuccessful. Measuring the amortized cost and value of intangible has become both more important and more feasible over time. The increasing trend over recent decades in intangible intensity and relatedly in economic volatility, adjustment speed, and scalability have made reported earnings and book value poor proxies for future earnings. For example, Arnett find that the underperformance of value factors over the last decade is due in large part to accounting measures such as earnings and book value failing to capture increasingly important intangible assets. The dramatic increase in the availability of data and improvements in computing and data analysis methods enable relatively precise measurement of different types of intangible assets. My second observation can be summarized as follows. Big data and ML methods should complement, not substitute for traditional data and analysis. While big data, alternative data, and modern analytical tools are increasingly important, they should not substitute for a robust framework that incorporates economic, financial, and accounting structure and uses the wealth of financial and non-financial information that is already available. Out of sample validity of insights from pure data mining is often questionable. Extracting information from data involves extrapolating from past relationships. In some cases, the statement "this time it's different" actually holds, making it difficult to extrapolate from past data. Relatedly, judgment often has to be incorporated, which is difficult to do when forecasts and estimates are derived from black boxes. Simple, traditional models that incorporate economic intuition and provide more visibility into the estimation process are more suitable for incorporating judgment. Some interpret developments in ML and big data is implying less need for structure. Let the data speak for themselves. In my view, the opposite is true. These developments suggest an increasing role for structure and domain expertise. The increasing trends in intangible intensity, economic volatility, adjustment speed, and scalability mentioned above suggest that flexibility to account for changing circumstances is particularly important these days, and the richness of available data and advancement in ML methods can facilitate such adjustments. The first wave of artificial intelligence models use expert systems, while the second shifted to machine learning. Combining the two or more generally moving from man versus machine to man plus machine approach may yield superior results. The structure and operation of many quant funds demonstrate this issue. They often pay relatively little attention to accounting, financial, and economic consideration, or they incorporate them separately. A hedge fund may have two separate teams, one working on the construction, the indicators, features, and the other focusing on training models using pull or indicators features to predict stock returns. However, the contextual nature of the features and the interactions among them suggests that the greater integration and a more robust process with respect to non-statistical considerations may yield better results. For instance, Dyer et examine quantitative investors' ability to navigate the impact of new accounting standards on financial data. They find the relative to funds that rely heavily on human discretion to make investment decisions. The returns of quantitative mutual funds temporarily decreased following the implementation of standards that change the definition of key accounting variables. This effect is particularly strong for funds that rely heavily on accounting data and invest in many stocks. A few recent studies demonstrate the potential benefits of incorporating financial and accounting structure into the analysis. For example, banks use structure profitability analysis and find that it leads to more accurate forecasts and do show that more careful measurement of accounting variables facilitated using XBRL data leads to improved stock return predictability. In my view, this direction is particularly promising. Nissan dives deep into the development, measurement, and contextualization of accounting factors, thereby providing guidance for selecting, measuring, and interacting accounting-based features when implementing ML algorithms. As noted, without structure and transparency, as is often the case with ML methods, the out-of-sample validity of pure data mining is questionable, and the ability to adjust the model and estimates for changing circumstances is limited. If the training period does not include evidence of circumstances similar to those underlying out of sample predictions, or more generally, when past code movements or patterns are not good guide for the future, the estimates are likely to be imprecise. In such cases, incorporating economic, financial, and accounting consideration is particularly important. This can be done through one, careful selection, definition, and measurement of the variables features. Two, imposing structures on the specifications. Incorporating no arbitrage conditions, allowing for select interactions, grouping, grouping variables into clusters. Three, adjusting the variables in a specification to the context. And four, modeling casual or quasi-causal effects when such identification is feasible. Recent research increasingly recognizes the importance of incorporating expert knowledge. For instance, Chen implemented deep neural networks to estimate an asset pricing model for individual stocks using the no arbitrage condition as a criterion function. They conclude a successful use of machine learning methods in finance requires both subjects a specific domain knowledge and a state-of-the-art technical implementation. I believe that this conclusion extends to accounting. Listo, compañeros, esto sería pues como la lectura de este artículo en el cual entonces, a manera de resumen, este artículo nos viene a dar, no nos da una definición de lo que es el Big Data porque es algo que abarca mucha información como tal, pero este artículo como nos viene a dar una revisión de la investigación que utiliza los grandes datos y los métodos de Machine Learning, aprendizaje automático, esto como para proporcionar información relevante para la valoración de acciones. Se centra también en estudios que utilizan o informan sobre las variables contables y que es muy importante tenerlas. Es muy importante agregar ese factor financiero, económico a la ecuación, a los análisis que se hacen de la Big Data. porque las finanzas realmente tienen que ver con todas las áreas, están allí implícitas. Bueno, también concluye con recomendaciones para futuras investigaciones, que fue lo que acabamos de leer. Y bueno, la idea principal es que tanto el Big Data como el Machine Learning ofrecen un gran potencial. Es crucial integrarlos en ese conocimiento y la estructura contable y financiera para obtener resultados más sólidos y comprensibles y apegados pues como a la realidad. Entonces, en este artículo nos vienen a dar como unas valoraciones acerca de la predicción de las declaraciones financieras incorrectas, el pronóstico de ingresos y finanzas, la evaluación de riesgo empresarial, la predicción del rendimiento de las acciones, los activos intangibles, la importancia de la estructura y el contexto en el que se dan esas mediciones. eh, Todo eso en gran medida para enmarcar lo que es el Big Data en este mundo tan avanzado, tan tecnológico que estamos eh, viviendo, que es muy importante ese análisis de esos grandes cúmulos de información eh, y cómo esto impacta en las finanzas, cómo hay una correlación entre la información, las grandes cantidades, el gran cúmulo de información que hay afuera, que es información que todos los días se está creando, todos los días está creciendo, y cómo poder analizar toda esa información en base a la ingeniería financiera. Espero que les haya gustado. Muchas gracias por su atención. Que estén muy bien.